All right, welcome back to our Life Insurance 101. Hopefully, you just watched part one, so this information is fresh. But if you're just joining us, my name is Mika Tardo, president of Set Sail Insurance Group. And in part two here, we'll go more in depth about the type of policy known as universal life. Okay, what we will cover. Well, first we'll go over what is universal life insurance, the types of UL policies, surrender schedules, riders and extra benefits, IULs versus VULs, triple compound interest, how to pick a good company, how do agents get paid, and finally 1035 exchanges. Okay, universal life. It has the greatest flexibility of all life insurance. Once money has accumulated in your cash value account, you may be able to vary the frequency and amount of your premiums. It may be possible to structure the policy so that invested cash value eventually covers your premium cost completely. Of course, it's important to remember that altering your premiums may decrease the value of your death benefit. These policies also may include one or more living benefits riders, such as terminal, critical, and chronic illness. How much does universal life cost? Well, as mentioned back in part one, factors that determine the cost include the type and amount of coverage applied for, your age, gender, health, lifestyle, and family medical history. But additionally, since these types of policies are able to be overfunded, the excess portion of premiums can build cash value over time through a process known as triple compound interest. We'll get into more about that a little later. The types of universal life. Well, the first is called Guaranteed Universal Life, or GUL. It offers permanent coverage up to age 120 at a fixed rate without requiring an investment value. This makes Guaranteed Universal Life insurance risk-free and affordable like term life, but without the downside of expiring after a term. It's ideal for funding a special needs trust, leaving an inheritance, or protecting the assets you leave behind from estate tax liabilities. The second type of universal life is called Variable Universal Life, or VUL. It's where you have the option of actively investing your cash value in stocks, bonds, or money market funds. The value of your policy has the potential to grow more quickly, but with more risk. If your investments do not perform well, your cash value and the death benefit may decrease. VULs offer tax-deferred cash accumulation for retirement or college funding saving strategy. VULs are commonly used for key person insurance, business owners, premium financing plans, or estate planning vehicles. The final type of universal life policy is known as an Index Universal Life, or IUL. You can passively allocate cash value amounts either to a fixed account or to an equity indexed account, or both. Policies offer a variety of indexes such as the S&P 500 or the NASDAQ. This essentially earns interest just like an FIA, or fixed index annuity, which we covered in our annuities presentation. IUL policies are more volatile than GULs, but less risky than VULs because no money is actually invested in the market. IULs offer tax-deferred cash accumulation for retirement or a college saving strategy. IULs are commonly used for key person insurance, business owners, premium financing plans, or estate planning vehicles. So all of these universal life policies have what are called surrender schedules, similar to any kind of annuity that we talked about in our annuities presentation. This is just a typical example of what a 10-year surrender schedule looks like. But it's important to know what your surrender schedule is before going into contract with one of these policies. Riders. Some life insurance companies allow the ability to accelerate your death benefit as needed with add-ons known as living benefits riders, or LBRs, which some people choose to use in addition to disability coverage. Examples of these riders include the chronic illness rider, if you're permanently unable to perform at least 2 of the 6 days active living, or ADLs, without assistance. The critical illness rider, it covers heart attack, cancer, stroke, major organ transplants, and kidney failure. And finally, the terminal illness rider, if you're diagnosed with life expectancy of between 12 and 24 months or less to live. Some of the companies that offer this rider only offer it at 12 months, while others offer it at 24 months. Make sure you know which one it is before you go into contract, because obviously the 24-month one is better. Additionally, as mentioned in part 1, some of the companies that offer these riders include them at no additional cost, while others are only available at an added premium. Furthermore, the payout percentages of these riders differs between the different companies who offer them. So it's recommended that you talk to a trusted broker who is contracted with several of these companies who can clearly explain the differences before you decide on which company to go with. Here are some examples of additional riders that can be added to your policy at an added premium. So, what makes universal life policies unique is that they have some additional features that no other life policy has. They allow virtually unlimited contribution amounts. After policy year 5, up to 50% of the cash value can be taken out as an interest free self loan that doesn't have to be paid back. You have full access to withdraw all premiums at any time after policy year 5. There are no age restrictions, RMD provisions, or IRS penalties for early withdrawals like you have with annuities. This policy is protected from lawsuits. It does not create taxation of Social Security benefits and is not affected by prenuptial agreements if started before marriage. All right, how do I choose what universal life policy is right for me? Well, just like we covered in our Annuities 101, VULs are actively managed plans where your money is gambled just like at casinos. And if life insurance is supposed to insure you, why would you gamble it on the stock market? Also remember, pandemics, wars, terrorism, climate change, natural disasters, resource scarcity, insider trading, and more recently, presidential tweets can all affect the market performance daily. You don't want to look like this when everything goes south. Additionally, as we covered in our Annuities 101, with all actively managed funds, because they're market-based, you have added management fees that increasingly eat away at any gains you make over time. IULs simply don't have this. So with all this said, it should come as no surprise that major financial publications like Morningstar, Fortune, Fox Business, and the Wall Street Journal have all written articles saying that index funds have outperformed actively managed funds 92% of the time over the past 15 years. And if you don't believe me, go ahead and Google it yourself. Also, many well-known financial gurus like Tony Robbins and Warren Buffett are huge proponents of index funds as well, especially as a first investment. Again, if you don't believe me, go ahead and Google it. Now that we see how IULs perform compared to VULs, let's learn more about how they actually earn interest. Just like passively managed Roth annuities, IULs earn triple compound interest through mimicking market indexes like the S&P 500. Triple compound interest, again, is interest on the principal, interest on the interest, and interest on the taxes they would have had to pay if earnings were taxed on an accrual basis. This is arguably the safest way to beat inflation. And again, this isn't a presentation about inflation, but just to give you an idea, this is where we were in 2013. We've pretty much skyrocketed since then. Here's a little recap of compound interest, which we covered more in our annuities presentation. So for a little IUL recap, they have high potential market-like gains without the risk. They accumulate triple compound interest. You have your death benefit, which is a non-taxable legacy to pass on to your beneficiaries. They can provide tax-free income for life. You can accelerate a portion of your death benefit as needed with your living benefits riders, and offers the most reliable protection against inflation. If you've already watched our other presentations, this next section may seem a bit redundant, but it's super important, so I'm going to cover it one last time. Always make sure to compare the financial ratings of life insurance companies you are considering before choosing who to go with. I personally only recommend companies with an A rating or higher. These ratings can easily be looked up online as they are public record. It's also a good idea to get quotes from a few top-rated companies before you decide on a purchase. You can easily save a few dollars a month or more by taking the time to carefully shop around. But make sure they are A-rated companies. I wouldn't trust a company's financial stability with the rating below that, even if it's a cheaper quote. Additionally, company name isn't everything. Just because you're familiar with a company name doesn't mean they offer the best plans. A good rule of thumb is the more they spend on advertisements, the less they invest in their products. Some companies offer far more competitive products than others. Don't be fooled by life insurance ads on TV, the radio, or online. They're usually by companies that have only been around for a short while or are just fronts for other companies with poor financial ratings. And finally, when shopping for universal life, it's highly recommended that you get quotes from a few different companies and compare them and the riders they offer. It's highly advised you meet with a trusted life insurance broker who's contracted with several of these companies who can provide an unbiased comparison of their products before purchasing. How do agents get paid? An insurance agent or broker who sells actively managed variable universal life plans makes annual commissions directly from their clients' investments deducted as a fee, regardless of if their client is making or losing money on the stock market. A broker like myself, who only works with fixed and passively managed index universal life plans, is paid directly by insurance companies based off the death benefit and annualized premium of each policy they bring into the insurance company. So you can have peace of mind knowing that these commissions never come from clients' investments. The last topic I want to cover is what's called a 1035 exchange. It's where you trade one whole life policy for another, and I'll explain why you might want to do that in a minute. The IRS allows you to exchange an insurance policy that you own for a new policy insuring the same person without paying any taxes on the investment gains earned on the original contract. This can be a substantial benefit or a tremendous loss depending on several factors. Number 1, the surrender schedule. If you're thinking about trading or upgrading your policy, be sure to check your existing surrender schedule to make sure that you don't have to forfeit any cash value you've accumulated, and if you do, make sure the trade-off makes sense, like you're getting a higher death benefit and or better living benefits riders. Let me tell you a story. So last year I ran into a guy who showed me he once had a policy with North American Company, which is a great company by the way. He had a death benefit of $300,000 and the critical, chronic, and terminal illness riders all included. And a couple of years into his policy, some insurance agent working for World Financial Group came along and somehow convinced him it was a good idea to 1035 his policy to Transamerica, where he would lose the critical and chronic illness riders because Transamerica didn't even offer them at the time. Additionally, he lost $100,000 of his death benefit and forfeited over $5,000 in cash value because his policy was still in surrender. Clearly, this agent, who was a scumbag by the way, knew what they were doing, and all they cared about was making a commission off this poor guy. These are the kinds of agents you need to watch out for. They're everywhere. I know this because this is a story I come across at least a few times a year. Okay, on to number 2, the type of policy you're exchanging. Make sure it makes sense for your needs. If you have a GUL but you want to add cash value, then switching to a VUL or even better, an IUL would make sense. But going from an IUL to a GUL or even to a VUL might not. Again, only do this when you have a clear objective in mind, not because some agent is trying to convince you to do so. All right, number 3, the amount of death benefit you're exchanging. In some cases, you can 1035 from one company to another with better financial ratings, and they'll offer you a higher death benefit for the same monthly or annual cost you're currently paying. This would be an ideal reason to do this, but not for the other way around, like in the example I mentioned in number 1. Number 4, the riders. If your old policy doesn't come with any living benefits riders, or only one like the terminal illness rider, for example, you might want to 1035 it for another policy that comes with all 3, depending on your needs. But make sure you're working with a broker who's transparent with you about what you're doing. Number 5, the fees. As I mentioned before, the fees with VULs are much higher than with GULs or IULs because they're actively managed plans. So if you want to reduce your fee burden, it might make sense to do a 1035 in that case, depending on your policy's surrender schedule. All right, finally, number 6, the financial ratings. We already talked about how important it is to only work with companies with an A rating or higher, so I shouldn't have to explain why this is important again. At the end of the day, doing a 1035 exchange can be really great as long as you're doing it for the right reasons. Be sure to talk to a trusted broker like me who can help you before making any rash decisions. That's all for our Universal Life 101. Feel free to check us out online at setsailins.com to schedule a free consultation and to see our other additional services you might be interested in. Thanks for tuning in. We'll see you next time.